Russia has followed through on its threat to attack Ukraine. Apart from the human toll that's expected, not surprisingly, we're seeing a massive sell-off across the board. Joining me is Michael Craig, Head of Asset Allocation at TD Asset Management. Mike, give us your thoughts on the market reaction to Russia's attack on Ukraine.
Good morning, Tony. Yeah, it's been a what you would expect in a type of reaction based on an advent of war. Safe haven assets, government bonds, gold, U.S. dollar, Japanese yen are all rallying, and global markets around the world in terms of equities are selling off, particularly in Europe, which is certainly seeing the hardest hit right now. And of course, not to mention the Russian stock market, which is down 25% this morning.
Now, Western nations have indicated they will ramp up their sanctions. What are the implications for Europe and North America?
I think for the European economy, the pain will be most acute. This is really going to hurt in terms of supply of energy, supply of natural gas. And so I think if there's a risk of a short-term recession anywhere, it's probably in the European region. In North America, in terms of business, this really hurts sentiment. But I don't know if, outside of the commodity complex, whether you're going to see a huge impact to economic growth in North America. This is really a European story, and for now, and I think that's where you're going to see the most acute pain in terms of growth.
Now, we're also seeing the price of oil and gas climbing rapidly, as well as wheat, a number of metals on supply disruptions. What do you expect to see?
So I think this is the kind of the secondary story that's coming out of this, and I think it'll be talked about a lot more, is that it's creating stress in already very, very tight commodity markets. Russia is a major producer of oil. Oil's up $7 this morning. Russia is the primary supplier of natural gas to Europe. Nord Stream 2 is shelved indefinitely, and Germany uses about 40% of their gas comes from Russia. So that's a real problem. You mentioned wheat. Ukraine and Russia are kind of the bread baskets of Europe, and you're seeing wheat rally. And not to be missed, Russia is one of the largest suppliers of base metals around the world. So all these various commodities are up materially this morning on I think the correct realization that supply chains and commodities are going to be impaired for some time as sanctions start to bite.
So what will this mean for inflation and rate hikes coming from central banks? Any thoughts?
So when we think about inflation, you really got to separate it into what's driving it. So it can be either driven through excess of demand, where growth is running too hot and there's just not enough supply in the economy, or it can be caused by shortages of global supply. This would be the latter of those two situations. And so the way we think about it is this is almost like a tax on growth. If you go to the gas station and it costs you twice as much to fill up your tank, you're going to consume less of other goods, and therefore, as a result, growth is lower. And so there's an initial shot to inflation, but there is a risk that this creates more of a stagflationary condition where prices of certain goods that are driven off commodities are high, but growth is tepid because of this lack of supply on the supply side of kind of aggregate demand. So much different scenario than what you would have seen in previous inflationary episodes. This is all about the tightness in the commodity markets and taking off a major supplier of commodities from the global trading system.
I want to talk about the conflict. If this turns into a lengthy conflict, what are the implications for markets going forward?
Well, and markets hate uncertainty, and I think they've been trading a little bit too dismissive of the risk of this. And I think that's part of the reason why you're seeing such a aggressive reaction today, particularly in the gold and bond markets. And bonds have been selling off most this year, and they've turned around quite sharply this morning. This really risks a quagmire. Ukraine is not Ukraine military was well trained. They've got about 250,000 soldiers. It's certainly smaller than Russia's, but this could lead to a real long-term quagmire for the Russian state, and that will create continued uncertainty. And I think the most obvious implication of this is a very, very weak European growth story going forward. So that would be our initial reaction. Obviously, it's early days. We're in the fog of war. It's really unclear about what Russia's trying to gain from this, other than just decapitating the Ukrainian state through military and governance, and ultimately imposing a state that's more Russia friendly or more geared towards the east. That would be my kind of initial sense, but it's very unclear right now to see. And the markets will trade in a very volatile fashion until some clarity comes out of this conflict.
Could this be an impetus to speed up the energy transition?
100%. I think it's now fairly well appreciated that the Europeans' approach to separating economic and kind of geopolitical fronts with Russia was incorrect. That energy was always part of that equation, and now as a result of that, they're going to be facing materially higher energy prices. And they will need to start competing on the LNG markets for gas. So they'll have to buy gas through LNG rather than Russia. And ultimately, I think this will lead to, I always think this kind of market adage is stability breeds instability and instability breeds stability. I would expect to see the West has kind of been drifting in different directions over the years. There's been a lack of leadership. My sense is that this will strengthen Western resolve, and it will certainly accelerate the transition from fossil fuels to non-fossil fuels in Europe for no other reason than survival. So that's probably, not to make light of a really terrible situation, but the kind of renewable energy story probably gets a boost from this on a longer term basis.
So given what's happening, from an asset allocation perspective, how would you view these markets?
Oh, incredibly challenging. We've been reducing our equity positions for a few quarters now, and have been increasing our bond positions just because bonds have been selling off, not because we had a crystal ball about this fiasco. But I think right now one of the things you'll learn is that in a balanced portfolio today, it'll be down, but it will be actually the returns will be materially offset from the rally in fixed income. And so this kind of goes back to the value of diversification. It's been a tough market to start the year, but certain asset classes have sold off a lot more than others. And this is the value of having a multi-asset portfolio to withstand environments like this, where sure everyone's down, but not materially so relative to if you have everything in one particular sector that's getting hit harder today. So diversification is key, particularly when you're in periods of stress. You may take losses in one place, but see gains in others through that diversification.
So Michael, if I'm concerned about my long-term retirement goals, what are the broader implications to me?
I think in the past, geopolitical conflicts outside of World War I and II, they certainly create a lot of volatility, but they don't particularly impair long-term growth. And so for investors, with a multi-year horizon, while today is a very uncomfortable day, and this year probably will be not great, I don't believe it's going to materially impact your long-term investment kind of returns. In many ways, you see a loss in one period, but then it sets up for more accretive returns in the next period. So certainly, if shorter term, if you got shorter term needs for your investments, that's something to think about, and it's all about structuring your investments. But longer term investors, I don't believe this is going to have a material impact on long term returns.
Michael, thank you very much for joining us.
My pleasure, Tony. Take care.